Good morning, everyone, and thank you for your patience. Welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and it's my pleasure and our privilege today to host the Washington release of the 22nd Geneva Report on the World Economy, Banking Disrupted, Financial Intermediation in an Era of Transformational Technology. This is as always, thank you. As always, the Geneva Reports are multi-authored, European-centric, but of international interest. And this year, the report is authored by Catherine Petralia, Thomas Philippon, Tara Rice, and Nicolas Véron. This is, I believe, the fourth, if not the fifth year in a row in which a Peterson Institute author has been one of the co-authors of the Geneva Reports. We're very proud of that. We see a real resonance between what we do and what the Geneva Report and CEPR do in trying to hit the sweet spot of being academically rigorous but highly relevant and topical. And it's been a great partnership, would slightly overstate it, but friendship and mutual fandom between Geneva Reports, CEPR, and PIIE. And we're fortunate to happen to have Ugo Panizza. Professor Panizza is visiting Washington today, and he is the overall editor of the Geneva series. Could you come up for a moment, Hugo?
Thank you very much. Thanks, Adam. And as Adam said, this has been our DC house for a while, not only because it's been a fantastic venue to do our US launch of the report, but also because, I guess our interests are so aligned that it almost always happens that there is a Peterson author in the report. So there was we had Joe Gagnon in 2016, we had Hangel Ubide in 2017, Nicolas now, and if I go back in time, we'll find more, as Adam said. So, but I will not take your time. So I happen to be in DC for some other reason, so it's great that this coincided with this. So I guess you'll introduce the authors, Adam.
One last question, Ugo. Just, do you know what the topic of the 2020 report will be?
Yes, it's going to be on coordination of fiscal and monetary policy.
Coordination of fiscal and monetary policy, an issue we care deeply about, and everyone should. But of course, as always, the focus in these kinds of events is on the authors making their own best case and best representation. And when you have something rich like Banking Disrupted, we're very pleased to have one of the four lead authors here. This is Nicolas Véron, who has been affiliated with the Peterson Institute for 10 years now. He is a senior fellow at the Institute and also a senior fellow at Bruegel in Europe, where he is one of the co-founders of that organization, another one of our spiritual partners. He's published widely on accounting standards, audit firm governance, banking supervision, financing of high growth firms, recently on the oversight of inward investment in the European Union, and very credibly and influentially recently on anti-money laundering in Europe, where his and a colleague's report seem to have definitely moved forward that piece of financial integration. Nicola, I think, has done a real service in recent years by being not only a European expert in the US, as we have here at Peterson, but someone who has been pragmatically optimistic about banking union and financial integration in Europe. He calls it as he sees it when Europe doesn't move forward the ways it should, but he retains a glass half plus full view at all times, and that is quite a balance. We could not have a better discussant of this report. I am very grateful that we have Tobias Adrian of the Financial Counselor and the Director of the Monetary and Capital Markets Department of the IMF. I'm grateful because Tobias is a leader in all kinds of applied research in the financial and capital markets sector, as well as monetary policy, where I normally run into him. He has really energized that department at the IMF. He is in infinite demand. It was very lucky for us that he was both in town and willing to make room in his calendar for this discussion. Prior to joining the fund, Dr. Adrian was the Senior Vice President of Federal Reserve Bank of New York and Associate Director of the Research and Statistics Group. He's also published extensively, including in the American Economic Review and other top journals. So again, trying to hit that sweet spot of academic rigor and policy relevance, we could not have a better basis for discussion between Nicolas and Tobias. So Nicolas, please. And I will pass you the ceremonial copy.
Thank you, Adam. Thanks very much for the kind introduction. Thanks to Hugo for being here and having masterfully led the project of this report. And thanks also to my co-authors, they're here. Catherine Petralia, who works at Cabbage, a fintech startup based in Atlanta. Thomas Philippon, who probably doesn't need an introduction in this group and also has a new book, which got a lot of attention recently on the decline of competition and competition policy in the US in comparison with Europe. And Tara Rice, who took great leadership, I think, in this report. We were fortunate to have her join the team when she was in the private sector at BlackRock, and then she went back to the public sector. She's at the BIS and works a lot on these issues in the CPMI, Committee on the Payments and Market Infrastructures, Secretariat with the Bank for International Settlements. So that was a great complementarity of perspectives from a fintech startup, academia, investment management, and then public sector for Tara and me from two think tanks to look at the topic, which is very amorphous still. I think when we think about the transformation of finance and banking in the age of data and mobile phones and all these technological transformations, we're still at a very early stage. It's very difficult. There's a lot of hype because there is a lot of venture capital money. It's still very difficult to get a sense of what the deep drivers of transformation are. So that's what we try to do in this report, but it's not the end of the conversation. I should also mention Sam Tosic, who works at Cabbage with Catherine Petralia. I thought he was in town today. I'm not sure if he's in the room, but he was extraordinarily generous and helpful also to help us. So he's not technically a co-author, but he deserves acknowledgement here. I will focus my talk roughly following the order of the table of contents of the book. I will not try to give a sense of everything that's in the book. There is a lot of facts and stories that I encourage you to look at. But we first take stock on the banking sector as it is now ripe for disruption, if you will. And we think it's useful to get the right sense of what exactly is happening. Then we look at the competition from both fintech and big tech. And we look at policy issues. One thing we didn't do much in the book is look at the competition from the public sector, and that central bank digital currencies. There was a panel here at the Peterson Institute, very rich on this issue of digital money and CBDCs. I encourage you to look at the video because it's very complementary with what I will be talking about today and very up to date. So big banks to start with. Big banks are still banks. One of the striking things that leaps to mind when you look at the current business model is that the activities that we associate with kind of traditional or old-fashioned banking are still very dominant in most banks' business model, and even for the largest. So the blue line here is the largest banks from a sample of more than 2,000 banks in the world. The red line is the smallest, and the yellow line is the median. And what you see here is that loans and deposits are still very significant in assets and liabilities of banks. Even for the largest banks, they are more than half. And conversely, in terms of the profit and loss, interest income is the majority of income, the overwhelming majority for most banks. Again, the red and yellow line, and more than 50%, even for the largest banks, which have a more diversified portfolio of activities. McKinsey, sometimes quote them, had this exercise last year of looking at the entire universe of financial intermediation in the world and trying to see the revenue drivers. Of course, it's a bit of guesswork, but it gives some orders of magnitude. And traditional banking revenue, retail banking, corporate and commercial banking, and payments on this account still represent 4/5 of the total revenue of financial intermediation. So the financial sector is still very much about traditional banking, despite all the transformations of business models in the last years and decades. Also, we look at the debate on economies of scale and scope in banking, and here there have been shifts in the literature. There was a pretty conclusive literature before 2000, more or less, suggesting that economies of scale and scope were exhausted at relatively low levels of input and at relatively low thresholds of, say, balance sheet size. The more recent studies, intriguingly, suggest a bit stronger evidence for economies of size in terms particularly of costs. So there might be that there were fundamental business driver forces increase in size of banks through the 2000s. But conversely, since the crisis, there have been reforms, particularly, for greater capital requirements on global systemically important banks and the like, so-called ending too big to fail reforms, which could create incentives to downsize. When you look at the footprint of the largest banks, the total assets of the top 10 banks, so it's not, of course, a constant sample, over global GDP over a long period, you see that increase in the 2000s, very significant, and leveling off after the crisis. We also look briefly at geography, nothing surprising here, but quite a striking evolution we charted looking at, again, long-term archive. If you take the 200 banks over the last almost 50 years, you get big changes in the distribution of the larger banks by origin. You see the Japan boom and bust and the extraordinary rise of Chinese banks in the last 10, 15 years. But what is interesting is that it remains basically in those three jurisdictions. So China, Euro area, Japan, UK, and US together represent the bulk of global banking. The rest of the world, or even the next 5 countries, which are Australia, Canada, Switzerland, India, and Korea, don't change much in terms of proportion of total assets. So we saw that's interesting, and that means also that by focusing on those 5 jurisdictions, as the book does, one captures a very dominant part of the landscape. So let me move on to the competitive challenge from FinTech and Big Tech. We did a survey of a number of market participants and stakeholders. It's not a very big sample, but it's a sample that's big enough to have relevance. And what is clear from this survey is that the current competitive pressure really comes primarily in the payments industry. No surprise to practitioners, of course, but very striking results here. And then the competitive pressure in other market segments is typically lower and more at a more early stage. So this beachhead in payments, so to say, of technology-driven companies, FinTech and Big Tech, is very much the current moment. Whether that will last, of course, is a matter of speculation. FinTech offers, no surprise here, speed, nimbleness, they're very agile, and also they don't have a legacy, and they can tailor their offerings to the customer in a very direct manner. Big Tech has a slightly different set of comparative advantages. They also have the technological savvy. They're a bit slower moving because they are very large, but precisely for that reason, they have the scale and the installed base of customers that gave them enormous power when they enter a market segment. Now, of course, both FinTech and Big Tech are at a competitive disadvantage to banks when it comes to regulation, and particularly the relationships with regulators and supervisors. In a way, relationships are a major competitive asset of banks in the supervisory community, and that shapes the current dynamics. And indeed, big tech in particular have been very cautious, big tech firms have been very cautious about coming into the walled garden of banking, the deposit taking and lending activities, and the separation of banking and commerce is still very relevant at this present moment. In the US, it's enshrined in law and also in practice. Walmart famously wanted to establish a bank in 2005 and was denied a license for that reason. In Europe, the separation principle between banking and commerce is less settled in law, but in practice, there is not that much difference because Europeans, as everybody knows, are so cautious about US-based big tech invading their economy. So in that question of whether big tech comes into banking directly and not only through partnerships or arrangements with established banks, the big outlier here is really China. China is the one jurisdiction among the big ones in the world where big tech companies, local big tech companies, particularly Alibaba through Ant Financial and Tencent, have gone directly into the financial business and not just indirectly or through partnerships or through relatively peripheral business segments like payments. Ant Financial and Tencent both have banking licenses. Their banks are not very big, but they also do a lot of lending and activities that can be described as deposit taking through other parts of their business proposition. And as you know, they've become extraordinarily big in terms of their importance in the Chinese financial sector, as my colleague Martin Schorzempa and others have chronicled in recent years. So not so much banking licenses in Western economies, a lot of e-money and virtual banking licenses. However, we give a lot of information in the book, but it's becoming obsolete by the day, of course, because this is a fast-moving environment and we're still at very early days. So I think one of the biggest questions going forward is how much will big tech companies, the ones we have in mind here, Apple, Google, Facebook, and the like, come into the banking sector directly through a licensing process. And even so, a lot of analysts think they will not want to do that. They will prefer to keep the banks as utilities and focus on data, but not moving money or having money on their balance sheet. That remains very much a question mark. So in that respect, I don't think we have come with any kind of predictive statement in that respect. There are different scenarios that will depend critically on the attitude of regulators. So whether big tech companies come into banking will depend to a large extent on whether they feel welcome in banking. And as banking is a heavily regulated industry, that will depend on public policy decisions, which will not just be following market development for that matter. And that connects with the question of how disruptive these new entrants will be for the established banking market. Of course, the disruptions from technology is there. Every bank wants to have a mobile app that is simple and transparent and direct. And we had a bit of discussion of that yesterday in a very rich panel that was assembled by my colleague Claudia Biancotti on data rights. But so banks have always been early adopters of technologies. There is nothing new here. Banks and financial businesses have always adopted technology before others. What is really the question mark is whether new entrants will disrupt their business. And here, if you take the long historical view, banks have survived many evolutions. They have absorbed many new entrants in the past, and they have also adapted to changes in the mindset of business driven by new technologies in the past. There was a very interesting example which we look at a bit of length in the dot-com bubble, which was Wingspan Bank, a bank that was set up as a separate operation by Bank One before Jamie Dimon joined them. Their slogan at the time, some of you may remember that. So it was a pure play internet bank in 1999, basically. Their slogan was, if your bank could start over, this is what it would be. So it sounds very much with what fintech companies are promising to their clients right now. Bank One put $150 million in investment into this. It was essentially a business failure. So Jamie Dimon later, as CEO, put a brave face by saying they had learned a lot from the experience, but it had to be closed and absorbed into the normal operations of Bank One after a few quarters. Now, this time might be different for at least three reasons. First, of course, big tech are very big. Second, big banks are not at the top of their game right now because they are in check post-crisis. And third, because consumers have not been very satisfied with banking services of late. So I will go through these 3 points before moving to my conclusion. The first point is very obvious. Big techs are big. Here is in market cap, updated data from what's in the book. So this is as of last weekend. And what leaps from there, of course, blue is US, red is China, yellow is the only one from rest of the world, assuming it's not a Chinese bank, HSBC.
It's headquartered in the UK and it's subject to UK jurisdiction.
Exactly. So it has its home country in London. And what leaps from this chart is that some of the big banks are pretty big in terms of market capitalization, and the big tech are much bigger. There are not many of them, but so the tail is longer if you look at the banking universe, but the really big tech have enormous firepower, and so they can invest, they can buy banks, they can buy financial companies. This is a big driver for the competition to come. The second one, of course, is that banks are still reeling from the crisis. When you look at share prices, which is arguably a crude indicator, they have not recovered and they have not been very dynamic in recent years. Of course, European ones have been particularly depressed in terms of price to book ratio, but actually the recovery is, compared certainly to pre-crisis years, is not there in any part of the world. And finally, as I said, customers of the banks are not very happy with the way banks have been serving them. This is Thomas Philippon's very frontier research on the unique cost of finance. And so that the cost of banking services measured in a holistic way, the red curve is a quality adjusted measure. And you see that it has been going down a bit in recent years. So maybe banks are getting a bit more efficient and cost effective for their customers thanks to recent competitive pressures. But generally, this cost has been very constant over a long period. So banks have not been very good at improving their services in terms of cost effectiveness. And that's where a promise for new entrant lies. Finally, concluding on the policy challenges, obviously policymakers have to worry about a lot of things. And here I list a few which the book goes into more detail of. In black are those that are pretty traditional in the banking sector. In red are those which are particularly acute in this new context of the entry of fintech and big tech firms. And by currencies, I mean, of course, all the monetary systems that comes with projects like Libra and also central bank digital currencies. And in dark red are issues that have always existed in banking, but are given more salience comparatively with the entry of those new players in the sector. And I'm not going, for lack of time, into each of these bullet points, but the point here is that financial policymakers have a lot of trade-offs to manage and a lot of choices to make. And it's not just financial authorities. I think a lot of these issues, particularly data rights, but also some others, will require new legislation. That was one of the themes yesterday at Claudia's panel. It's not clear that the existing legislation can be enough to manage all the new challenges that come from technology, artificial intelligence, and other deployments of new business practices. Libra, of course, was a wake-up call, and it's probably not going to happen, or at least is not sure of happening, but has forced the policymaking community to think more clearly about a number of those trade-offs. So at this point, there is a pretty cautious stance from the authorities collectively, and even what's in the book here, Tara Rice, one of my co-authors, works a lot of her time on Libra and related challenges in Basel. What's in the book is, again, no longer entirely current, but it gives a sense of the magnitude of the challenge as it was felt by policymakers and the fact that they're not at this point ready to authorize things for which the implications are not yet fully clear. I will conclude with the challenge of international coordination, because this is one of the things that keep me most obsessed in this kind of new environment. There are pressures towards fragmentation across jurisdictions. I'm not sure that's the right way to say it in English, but fragmentation of the international financial and data space along national borders. And some of this fragmentation is unavoidable because there are different preferences in different jurisdictions. And we had a good case of this yesterday with data rights. Clearly, the approach in the US, in China, in Europe to data rights and obligations is not identical, and there will probably not be complete convergence anytime soon. So that creates fragmentation. But some of the fragmentation is avoidable, not something that is necessarily linked to very deep political and societal currents. And the question here is whether there can be public policy initiatives to avoid that fragmentation from happening through institutional experimentation, which could take the form of coordination or even integration of supervision across jurisdictions. Certainly not for banks, but possibly for infrastructures and especially data service providers, which don't have a balance sheet, only work with data and could be more seamlessly integrated across borders if there was a common supervisory framework. So this is one of the many policy challenges that we discuss in the book. So the transformation is at an early stage. It's probably not going to be a mass extinction of banks. Banks will still be banks. That's at least our strong baseline scenario. Of course, nothing is completely predictive in this space. But the key message to conclude is that the choices of public policymakers, including, as I said, legislators, will be critical. Financial regulators, of course, must embrace new technologies for themselves. They will not have the same preferences everywhere, but there is a case for getting ahead of the game, not waiting for the crisis or the deadlock to become urgent and experiment, particularly with international structures, so that an adequate supervision could allow business and customers to reap the benefits of all these new technologies. Thank you very much for your attention, and I'm very much looking forward to Tobias' discussion.
Thanks, Nicolas, for the great presentation, and thanks, Adam, for inviting me to be here. So this is a fantastic report. It's very, very rich. It goes over many stylized facts of the banking system, of the policy debate, and I think we got a very good flavor of that in the presentation. I would, of course, urge all of you to read all of the 120 pages. It's really very well done. So I'm going to go a little bit into a couple of areas of the report, into some depth. Of course, I can't cover everything because it is a pretty big field. And I'm also going to follow the structure of the report, which is, number one, the death of banking. Is banking doomed for failure, which is the first question. The second question is about the interaction of big tech and fintech. So are banks under threat from big tech and fintech? How are banks going to react? And then, of course, the public policy questions. This is a chart from the book. So I just copied the chart from the book because I think it's one of the most striking charts. And it's probably, one of the most important charts for banking today. These are net interest margins since 1989. And if you went further into the past, it would extend up. And so basically, we have been on the downward drift for many decades. And when you look at the magnitudes, we went from 0.04 to 0.015, and it's still going down. So bank profitability is massively under pressure. And when you look across the world, different banking systems are differentially impacted by this pressure. Europe is particularly hit hard, where, as Nicolas pointed out in his charts, market-to-book ratios are way below 1 for the vast majority of banks in Europe, because basically they're not profitable. In the US, somehow banks are able to be profitable despite these very compressed NIMs. And I think that Europe has a lot to learn from the US in that respect, because, of course, unprofitable banking is a financial stability threat at some point, right? Asia is a little bit mixed. So there are some banks that are profitable, but there are also many banks that are not profitable in Asia. So how to live in an environment of low interest rates is a major policy challenge. I think ultimately it will require lots of structural reforms, in particular in Europe. There's probably some sort of overbanking. And of course, the lack of profitability then becomes a constraint on monetary policy, because people argue that, well, if you keep lowering rates in negative territory, you're going to run the sector into the ground. And that's, of course, not the right answer from a public policy point of view, right? You should change the structure, make the system profitable so that you can usefully deploy monetary policy. So I think, there's quite a bit of discussion around this issue. Of course, what is driving the downward trend in NIMs, what is driven by the downward trend in interest rates, is not the fact that monetary policy is easy. It's the fact that productivity is low and the populations are aging, right? There are very fundamental factors that have been driving down interest rates, are driving down NIMs, and banks have to adapt somehow. So do they adapt? Well, this is, again, a very, very nice chart from the paper. And so you can see this is only going back to 2005. I think it didn't have enough data globally to go back all the way to 1989. But ROEs clearly have been coming down over many years, and in particular in the great financial crisis. And they're sort of stabilized in the past decade. Why have they stabilized? Well, because there's quite a bit of cost cutting going on. So there is restructuring going on. It's probably not enough to really counteract the vast compression in NIMs. So especially in Europe, I think a lot more needs to be done structurally to get profitability back. But here is one of my favorite quotes from the report. Over the years, the banking industry has exhibited remarkable adaptability to changing conditions. Its fate is seldom as bad as the figures indicated it should be. This is from the Banking magazine in 1960. So throughout history, people thought that banking was going to be doomed and was going to end, and it never has. And as Nicolas pointed out, right? I mean, turning to the fintech issues, clearly banks are adapting to the new environment. They're adapting to the low interest rate environment, and they're going to adapt to the fintech environment. But clearly also both of these are reshaping the industry. So yes, banks are going to survive, but the way they look probably over the next decade will be quite different from the way they look now, right? I mean, these are very, very strong forces. These are very strong headwinds for the banking system. And the report makes a very nice point about that. So number one, I mean, yes, so they will survive low interest rates, but then are they going to survive the barrage or the attack from the fintechs? And here's another one of my favorite charts from the report. So this is showing some of the big techs on the left side. So this is the number of accounts. And you can see Facebook is 1,000 million, which is like a billion or something like that. I always thought Facebook had 2 billion, so I don't know whether, I always thought it was 2 billion, so I think it's even bigger than what is in this chart. But clearly, relative to the banks, and so the age is on the x-axis, right? Like Citibank, JP Morgan, HSBC, they're over 100 years old, but even over 100 years, they haven't managed to be as big as the tech companies that are only like 10 years old or something like that. And that is the threat, right? I mean, the threat is that Facebook or Google is going to do what Alibaba has done and is massively going to enter into banking-like services, right? And what is going to happen then? And either JP Morgan is going to move up there, and they're going to be, or Citibank is going to move up there, and they're going to have a billion users or so, or Facebook and Google are going to become more like banks, and we don't fully know yet what the outcome is going to be. And the key issue is that it depends on policy, right? It's going to depend on what regulations, what lawmakers are going to do over the next 5 or 10 years. This is going to determine whether, who the winner is ultimately. So regulations and lawmaking are going to be key going forward. So I want to zoom into one issue that is discussed in the report, but where there has been a lot of the policy discussion over the past 6 months. And as Nicola pointed out, Tara Rice is in the CPMI, and I've worked very closely with her over the past 6 months on a report that the G7, together with the IMF and the CPMI, released at the annual meetings on stablecoins. Because, of course, there's lending in fintechs, but lending even in China, which is by far the most advanced country in terms of fintech and banking, the lending component is relatively small. What is massive in China is payments, right? I mean, you all know that, the payments of Tencent and Alibaba are bigger than MasterCard and Visa combined, right, on a daily basis. And I think, again, Nicola pointed to Libra. I mean, Libra was proposed in July, and it has completely changed the policy discourse, right? I mean, it really has focused policymakers on this question about stable coins and what the policy response should be. So I just want to spend 3 slides on walking you through a way to think about the stable coins, because I think this is really where the policy debate is today. So I want to go a little bit deeper into that one particular topic. So when we think about bank deposits, right, they are denominated in the unit of account, say in the US dollar here in the US. They are exchangeable at fixed value. You know that you're going to get $1 if you put $1 in. They're backstopped by the government, so there's deposit insurance, discount window backstop. And on the asset side of the balance sheets are all kinds of assets. So there could be treasuries, but they're loans primarily, as Nicola pointed out. Now, with the stable coins, there are actually many different flavors of stable coins. So one stable coin is what we call synthetic CBDC, and this is basically where China has been going. So China has basically required Alibaba and Tencent to hold their reserves with the central banks. So the backing asset are the central bank reserves for the stable coins of these Chinese internet providers. The denomination is renminbi, exchange is pledgeable. They don't have a backstop, so they don't have discount window access and deposit insurance, but they do hold, they have a 100% reserve requirement with the central bank. So that is pretty stable, right? And as, again, Nicola pointed out, there is a lot of debate about virtual banking licenses. So Hong Kong and Singapore have, and Switzerland have issued virtual banking licenses. These are, specialized banking licenses that don't allow you to have branches, and that are basically created for fintech firms and for telecom companies. And so you can basically acquire a virtual banking license and run a stable coin in exactly that way, right? Because at that point you can basically put all of your, say you issue tokens, right? When your users gets a token, he or she gives you dollars, and then you take the dollars, you put it into reserves. So that's perfectly possible. So it's a very simple, very, very narrow bank that you could run as a stable coin. Of course, in practice, what we see, what exists at the moment is more like what is e-money. So the backing assets are not in central bank reserves. They're in some safe and liquid assets. So for example, in bank deposits. So for example, the US dollar coin, which is one of the biggest stable coins in the US, they're depositing with one of the major banks and a couple hundred million. Some of these stable coins are now in the billions. And the backstop is private, but the denomination is in dollars, so it's the unit of account and of a fixed face value. Then there's another version, and this is where I would put Libra, which is what I call I-money. So the denomination here is not one currency. In the case of Libra, it's a basket of currencies. Or they are, for example, gold stable coins. So that would be another form of I-money. So the exchange value is variable. There's no public backstop. And the backing assets are mixed. So in the case of Libra, there would be some sort of reserve portfolio that consists of treasury securities, bank deposits, and all kinds of other stuff. But of course, you never quite know whether you're going to get exactly that value back. So this is one way to think about what is different between bank deposits and these private forms of money, right? Why, of course, with any stable coins, all of these variants of stable coins, there are always risks. And when you think back about the history of banking, right? I mean, we introduced the Federal Reserve and the FDIC because banks were very unstable. So, probably privately backed stable coins, they do have default risk, market risk, FX risk in the case of Libra, liquidity risk, etc. And probably it's not going to go well sooner or later. So banks are certainly better at offering exchange stability. For sure, you put a dollar in, you get a dollar out. And while the stable coins are privately backed, privately run, so they're going to have problems. So why hold stable coins? Is there a future in stable coins? Well, probably there is a future because, and this is again something that Nicolas alluded to, right? Number one, transaction costs are very low. You now have US dollar coins in 80 countries, and you can transact for free. They have global reach, so you can transfer across borders very seamlessly. You don't have to go through correspondent banking services. I mean, I have a bank account a Commerzbank account in Germany and one in the US, and it's both very costly and very lengthy to move money. With these stable coins, it's seamless and free. And of course, they're interoperable, right? I mean, these different stable coins are very interoperable already today. And in some countries, of course, not in the US or Europe, but in many countries around the world, actually, fintechs are trusted more than banks, right? Because there are all kinds of governance issues in the banking system. And finally, I mean, this is the digital life, right? I mean, Generation X, they live on phones, and all they do is on phones. And of course, my bank has an app, but Google and Amazon and Apple, they're extremely good at the user interface, and our banks are like at par in terms of how they relate to Generation X. So the tech firms are integrated into our digital lives. And then, of course, there are the network effects. So that's the billions of users of Google, etc. And that's a huge threat. So, I think stablecoins do have some potential because they have all these benefits. I don't think that bank deposits are going to disappear. I think this is vastly, people sometimes worry that like banks are going to be made inexistent, and I don't think that's ever going to happen. I think there's some role for stablecoins, and there's some role for bank deposits. And stablecoins might not be very large, but I think there's some role for it, and they might be somewhat large, but they might be very large in certain segments of the market, like in remittance payments, in cross-border payments, and of course they might be very powerful for financial inclusion. So now let me turn to the public policy. And so in terms of public policy, again, the report is going over all of these issues, right? There are financial stability issues, because if stablecoins were to be large, or if internet lending was to be large, that has financial stability implications. There are consumer protection issues. Bank consumers are more or less protected by law in most countries. I mean, they are not, the existing banking laws don't apply to fintech firms because they're not banks. Their financial integrity, I mean, the biggest hurdle for most of the fintech companies is how to deal with financial integrity, right? So AML, CFT, how to make sure that your network is not going to be used for illegal purposes, huge issue. The competition angle Nicolas mentioned, so suddenly you might have firms with 2 billion users. There are market power issues that are way beyond market power issues in the banking system. There are all the data issues. It's a huge debate, and many countries have different approaches around the world already. And then there's the monetary policy control issue, right? I mean, like US dollar coins can undermine small countries with unstable monetary systems that much more cheaply and that much more quickly. So, we get a lot of countries that are freaked out by that and they want to do something against it. So one option, what do you do with a stable coin? So one thing is to basically say, we're going to regulate stable coins. These are kind of like shadow banks, so we put some regulatory parameter on them. And so the FSB right now has kicked off a working group on regulating stable coins, which is in some sense that approach. Another approach is to co-opt these fintechs and make them into banks, so into very, very narrow banks. And that's in some sense the Chinese approach, right? Is to say, well, you guys, I mean, a stablecoin is like a very narrow bank, and then you just give it a very narrow banking license and allow it to hold reserves. And so this is what we call sort of like the synthetic central bank digital currency. It's not a central bank digital currency because it's not the central bank that issues the currency, but as a user, you know that your tokens are backed by central bank reserves. So, one way perhaps forward is just to make the fintechs into banks and then regulate them like banks. And that is exactly what a lot of the banking industry is saying. It's like, well, let's make sure that there's a level playing field, right? And of course, banks themselves could do this as well. So I think, many, many policy issues. I think there are many dimensions to think about. It's going to be very exciting, but also very much determining how the future of financial intermediation looks like. To conclude, the report is great.
Thank you for a fabulous discussion, Tobias, and thank you, Nicolas, for the presentation. I'm going to join the speakers on stage. Thank you. As Tobias rightly said, this is an incredibly rich report, an incredibly complex area for regulation or for supervision or just for worrying. But let me take it back a step, Nicolas. Tobias, in his remarks, made reference to the fact that there is overcapacity in banking in a lot of places, particularly in Europe. Tobias's predecessor at MCM at the IMF, Jose Vinales, made a featured speech about that here at the Institute several years ago, mentioning Commerzbank. Behooves me to remind people that Commerzbank and Deutsche Bank have neither merged nor exited in Germany, and so weiter and so forth. You do deal with this in the book, in the report, but could you say a little bit more about the interplay between the fact that there's probably overcapacity particularly in Europe, but also arguably in China, in banking, and how that underlying reality interacts with these disruptive forces you're talking about?
Yeah, and European banks have this line which Tobias alluded to, which is to say, regulation should be really nicer with us because we have all these challenges from technology, and that's difficult enough. And if you want to keep national champions or European champions in the banking industry, you better loosen the screws of regulation so that we can at least survive. Obviously, that's not the right way to look at it from a policymaking perspective. And what I think is needed in Europe is sector-wide restructuring without going into the easy parallels with the steel industry or other industries that have had to restructure in a very deep way in the past. I think what we need is a lot of consolidation, a lot of changes in business portfolio, and yes, a lot of exits from the market, whether that's through M&A or through other channels. Now, in fairness, I think in the European context, where at least most banks, even though there are a lot of publicly owned banks which pose challenges of their own, and we see that right now with a very interesting case, which is NordLB, Norddeutsche Landesbank, in Germany, which raises very difficult competition policy issues. As a public bank being rescued by public banks. There is an indication from media reports that the Commission could authorize that, and this is actually quite disturbing in terms of state aid control, in terms of the level playing field and the integrity of the system. Most of these banks have private sector shareholders. They're technically market driven. And so the market has to provide the answers. There has to be sorting out of the sector through market mechanisms under pressure from technology, low profitability, and yes, regulation, because this regulation is needed and it's apt. There is no good case for loosening it. So my short answer to your big question is this is in the hands of bank managers. This is in the hands of the leadership of those banks, so that they execute strategies that make sense from a business perspective. And I think, to put it slightly bluntly, I think there is a gap of leadership and quality of management in the European banking sector that has a lot to do with the slow adaptations that we're seeing.
Can I push it a little further, and Tobias can decide to come in or not as he chooses? I mean, one way of looking at that quote from 1960 from the banker that you both reference is that for all that talk, there is no competitive pressure on banking. These places survive no matter what. They're cockroaches. You know, nuclear war takes place in the form of the global financial crisis, and still they're still alive. So, I mean, Nicolas, are you being too wimpy by saying, you know, oh, it's up to the managers? I mean, isn't there something on the public guarantee front that needs to be done?
That's where I mentioned NordLB, because it raises exactly that question, whether those guarantees are acceptable in a policy framework where in the big scheme of things, we have to rely on market forces because we don't know how to do it otherwise. Now, it is a fact that banks are called institutions. There's only commercial firms that you would call institutions. And there is a hybrid nature because they have been publicly licensed for centuries, because of the roles they have played in financing in Europe wars between nations and the like. There is a connection to the national story that is difficult to disentangle. So yes, we should move to a place where these are commercial businesses. There is a Europe-wide level playing field. I think we're moving there. I think policymakers are by and large, and I have a lot of qualifications, as you said in your introduction, but are by and large creating the right framework with banking union. But it will take a long time until you see the market forces really being the drivers of evolutions there.
Yeah, I wouldn't be quite as nice to the European policymakers. I do think it's striking how little cross-border mergers there are in Europe, right? I mean, if I think back in the mid-90s when the vision for a common capital market and the common banking, was laid out, I would have thought that by 2019 there would be, massive amounts of merger to exploit those economies of scale that you were alluding to earlier. And we really haven't seen that. And I think the fragmentation in corporate law, in lending law, in banking laws hasn't been addressed. And capital markets union is, even in worse shape, right? And unless you have more capital markets union and more common approaches legally across European countries, I think you won't see enough cross-border mergers in Europe. So I do think there's a work plan ahead for the European policymakers.
Thank you, Tobias. Let me ask you a question, which then Nicolas can come back on. So you made the very interesting point in your slides about stablecoin versus traditional bank deposits, that the way the People's Bank of China, their system has gone is to some degree creating what you, I think rightly, called narrow banks. Yeah. For this purpose. For a long time, the intellectuals around bank regulation always scoffed at narrow banks. But my limited experience in this area in Japan, for example, with postal savings suggested there were some, it wasn't as open and shut. And then you can talk about other kinds of banks in Europe as well. So is there some reconsideration underway about the viability of narrow banks in this technological environment, or is it still just something that the Chinese threw together, but it's not something we want to emulate?
So I think what happened in China is that Alibaba and Tencent grew very, very large in terms of payment services. And the PBOC said, wow, I mean, this is outside of our control. And, because a lot of that is not in the bank. So It's true that Alibaba owns a bank, but these payment systems are not run out of the bank. They're run, they had like a reserve fund, and that reserve fund was invested in all kinds of money market papers. As you know, they have the biggest money market mutual fund in the world. And so PBOC was just very uncomfortable. So they put a 100% reserve requirement, which is effectively like a narrow bank. And so our thinking around that is, one way to go is to sort of try to regulate these emerging fintech companies. But the other way is just to say, look, these are very simple bank balance sheets. Let's give them a very simple banking license. So the OCC here in the US had proposed a fintech banking license, which was somewhat simple, even broader than what I'm proposing here. So what I'm proposing is even narrower than the kind of OCC license. But at that point, you just apply banking regulation. Now, they're very simple animals, so you probably don't need a leverage ratio. They are 100% backed by central bank reserves. And so it's pretty simple. But like in terms of AML, CFT, in terms of all the standard stuff you do with banks, you just do that, and that's it. And at that point, banks could operate that, fintechs could operate it, telecoms in some countries could operate it, but everything would be on a level playing field. I think this is the appeal. It's not the only way to go, but it is certainly one policy option to think about.
Great. Nicolas?
One thing on this, which is, I think we'll see very different choices in different jurisdictions, because that makes sense. And the needs and the trade-offs from a national public policy perspective are not identical if you're in the US, if you're in Zimbabwe, if you're in China. And therefore, we will inevitably see different scopes for narrow banks, for central bank digital currencies. There will not be a single global standard. And we'll have to live with that. It's going to create frictions, of course, because the global financial system exists and has some openness between jurisdictions, but I think it will have to be managed as such.
So that's perfect for what will be my last question before I turn it over to our distinguished audience. You concluded, Nicolas, by emphasizing that you among your co-authors spend a lot of time worrying about these international differences and the fragmentation of jurisdiction. So again, partly to be provocative, partly because I think it has some merit, let me pose the question differently. Why can't the implicit or explicit message in both your report and in Tobias's discussion was, you have to take advantage of this technology, we have to let it grow. I mean, why can't a regulator in a given country just say, nope, we're not playing that game? And so first is, what do you think gets given up if they do that? And second, how vulnerable is a given jurisdiction to being, essentially race to the bottom, euro dollar style of getting around it if it chooses to say, we're not playing this game?
I think this is, in a way, beyond what the report explores, because this is your question, as I understand it, is really about the future of currencies.
So no, it's about the future of financial services.
Yeah, but the narrow banking point and the stable coin point, as Tobias introduced it more than the report does, in fairness, is really about the very much how money will be managed in the future, and what currencies really are, and what roles they play in society. So it goes beyond banks as institutions. It's really about the monetary system. And I think one of the interesting things that made me think in Tobias' presentation is this question of differentials of trust. Where is the trust in a given jurisdiction? Are banks trusted? Is the state trusted? Is a fintech perhaps trusted more than the state, or let alone banks? And I think this is where you see different propositions and different trade-offs in different jurisdictions, because I think by and large, in many advanced economies, banks, for all the fact that people hate them, have a capital of trust when it comes to putting money there. And the state has a capital of trust in terms of ensuring a minimum degree of stability that you cannot take for granted everywhere in the world. And these are the fundamental questions that are raised with these technological applications. Now, with Libra, to go back to your question, public policymakers have gathered in Basel and elsewhere, and they have said, no for now. They have been able to give a collective response to that project, and the response is negative for the moment. How it will play out, frankly, we don't know, because we don't know how intrusive, pervasive a number of those technologies will be able to prove to be, even if policymakers try to close the door. And that's where there is a lot of experimentation needed.
Yeah, I couldn't agree more with the notion that it's all about trust, right? I mean, so what we want to see is a system that is trustworthy, that is stable, but that is taking advantage of the new technologies. And I think finding the right trade-off between those things is the key. And I agree that some jurisdictions might want to have more of the innovation through the banking system. Other jurisdictions already have done it through the telecoms. This is primarily in some lower income countries around the world where we have seen massive benefits in terms of financial inclusion through FinTech, right? I mean, because now the majority of the population has access to cell phones or smartphones, and so you don't need bank branches, right? That has been a huge driver of economic development, of inclusion around the world. And I think, we have at the IMF developed this Bali FinTech agenda together with the World Bank, where we lay out 12 dimensions of policies for FinTech, which includes financial stability, monetary policy, integrity, legal frameworks, data, etc. And basically our key message is you have to take a balanced approach. So you don't want to forbid everything. Of course, we can always forbid everything, go into autarky, and we don't have to worry. But we do want to take advantage of the benefits without risking the trust of the financial system, because that is what it's all about. So how do you get the benefits without incurring undue risks? And having a balanced approach, there's probably not one solution that fits for all countries, but I think there's certain principles, economic principles, that every policymaker wants to think about. And these are about, what is a token? What is the balance sheet of a stable coin? How does lending with big data function? These basic economic questions, I think, are questions that are common across jurisdictions.
To add something, Nicolas?
Yes, this connects obviously to considerations of the possibility and efficiency of capital controls in a lot of jurisdictions. So when you don't have capital controls, you have a different set of challenges from when you have them or when you consider imposing them in some situations. I think this is where we will see also a lot of experience accumulating in the years ahead.
Okay, so just to put a timestamp on this, I am pessimistically concerned about a lot of regulatory arbitrage downward, I think more than my colleagues have voiced. So let's open it up for on-the-record conversation. Tobias has graciously agreed to be on the record throughout this morning. Jessica has in front a roving mic, and please identify yourself.
I'm Rory McFarker at MasterCard. I just wanted to go back to the basic question of big tech entering banking and to ask, it seems that you started off the presentation of the report with charts about the declining net interest margins and declining and the overbanked struggle for profitability in the banking sector. It seems to me that that is the strongest argument for why big tech will not enter banking, namely that banking is not a profitable industry to be in, and that relative to other sources of revenue that they have found, and in particular, advertising is obviously a very profitable business for Google and Facebook and for other companies, and so that gives them an incentive to look for adjacencies, to look for example, transactions data that will prove the value of advertising and in turn raise the value of their advertising franchise, but it does not make them want to get into the borrowing and lending business unless it is accretive to their core franchise. So I'm interested in your reaction to why, from the perspective of big tech company, they'd actually want to get into this
Zero profit
business.
Yeah, I mean, I think that you alluded to some of the answer of that already, right? Is that even if the payments aren't profitable, it might still be useful to accrue other services like advertising or sales. I mean, when you look at some of the fintechs in the US, they do a lot of financial services without being regulated at the bank as banks, and that's exactly the regulatory arbitrage issue. And this is what the banks say very often. They say, "Look, I mean, now all these fintechs do all kinds of stuff, which is not quite banking, but it's very, very close to banking." And why do they do it? Well, they do it because this helps them in their core business. So I think that even if payments is ultimately going to be a very low profitability business, it still can help the platforms to be relevant and to generate revenue in some other way.
So I think the report, both the charts that Tobias showed and the ones I included in my deck, show a nuanced picture of profitability in banking, especially when you look at it from a global perspective. Yes, there is a decrease that seems to be secular in net interest margins, but there has been a rebound of return on equity. There's still a lot of revenue from traditional banking, which is what I showed in my slides. So I think there is a business bet to be made on the possibility for profitability. It depends on a whole set of assumptions. And to clarify the little difference we were appearing of having between Tobias and I, for example, with Europe, I wasn't defending the policymaker stance. I think different policymakers are pushing for very different things in Europe, national, European, sometimes within the same institution. So our positions are less far apart as they may be looked. But the banking relationship is very sticky. It's a very long-term relationship. If you're a big tech that thinks long-term about their business, I'm not saying it's necessarily attractive, but it brings things that the advertising relationship doesn't necessarily bring. And that's why I'm not predicting the entry of big tech into banking outside of China, but I think it cannot be ruled out at this point. We just don't know.
Quick question, Nicolas. Wasn't there a literature in the past that claimed universal banking was going to outcompete various forms of segmented banking precisely because of those kinds of arguments? It didn't empirically, that literature turn out to show this didn't work.
I think there have been, swings of the pendulum in that space, frankly, over time. So it depends a bit on your time horizon and what kind of interval you're looking at. There are banking conglomerates. If you look at the US, the direction of travel, by and large, has been towards universal banking over the last decades. Right. So the synergies are elusive, and they're very difficult to quantify and to get the analytical framework right. But again, if you take the real long historical view, you see a shift in both directions. And what is clear is that this technological wave that's coming will create specialized banks, will create specialized financial firms, but will also give rise to new types of synergies.
Okay, please.
Diane Ellis with the FDIC. My question is about open banking. Policymakers in Europe have taken a very different approach to this issue than in the United States, and I'm curious about whether you have views about how that might affect the development and the potential disruption that FinTech might provide in those different jurisdictions.
And can you give a quick definition of open banking for our internet viewers?
Yeah, open banking is legislation that forces banks to make their data, upon consent of the user, of course, accessible to other market participants, especially fintech. I think that's a standard definition, and it's been legislated in different forms at the EU level, specifically in individual member states, with I think a bit more specificity in the UK, and there is a debate which is not settled, and the way it's covered in the report shows that on how much change it has already brought, how much the fintechs are able to use this data in practice as opposed to in theory, and how much competitive pressure it creates on the banks. So the banks complain a lot about open banking. They say it's completely asymmetrical. We have to give our data to the fintech and big tech. The fintech and big tech don't have to give any data to us. It's unfair. But how that's actually tilting the competitive field right now, I think it's very early to have, maybe Tobias has a clearer picture, but I have struggled with this question in the preparation of the report.
I think there are policy trade-offs, and I don't think that countries are going to all go the same way, as was pointed out already. I think philosophically there are very different notions of who should own data. You know, do you own your own data? That's ultimately the question, right? So as a consumer, are you able to move your data to other providers? Or is the data owned by the bank or the financial services company? So it's a basic philosophical and legal question, I think, that is at the core of it. It certainly has tremendous impact on competitive forces and profitability, and it's certainly another force that is going to put a lot of pressures on profitability in Europe over time, and so. It's going to put more pressure towards structural reforms.
But it also depends on how it's enforced and implemented in the real world. Banks, of course, are very good at creating obstacles to the sharing of data, even so there is some legislation that asks them to do so. So the exact boundaries of what is shared, what is not, in what conditions, at what speed, on what platform, etc. I think this is still at a very early stage of observation.
Could I ask the lady there to go to the standing mic, please? This will be the last question.
Linda Jane with Georgetown Law. I have a couple of questions. The first one being, I want to explore a little bit more about, Nicolas, you mentioned that at this moment, there isn't that much separation. There is separation expected between banks and commerce, but less so in Europe. But as Tobias mentioned, you already have examples of big tech doing bank-like activities. For example, I was thinking of buying Amazon Kindle the other day, and I found they were offering me 5-month installment payments. How is that not a loan? But they are offering such services. And then this week, Facebook Pay has launched its services in the payment services across not only Facebook, but also Messenger. So I want to explore a bit more, what are the pros and cons of big tech entering finance? Is it as awful and evil as everyone says? And then if we have, the expansion of services like Facebook Pay and Venmo, for example, where we can all keep our balances with these fintechs, then at some point, Tobias, you were saying that there shouldn't be an issue with having so many, a threat to bank deposits by these big techs, but at some point, there should be a threshold where it will become difficult for central banks to manage monetary policy if my babysitter, for example, keeps her savings in her Venmo account. So thank you.
Thank you.
I think these were very good and very deep questions. So let me just make 2 points. So, one point is that clearly banks are very aware of all of this, and there's innovation going on in every bank that I talk to. And they are working very actively with the tech companies in order to offer new financial products or offer existing financial products in new ways. So it's not entirely clear that the big techs actually have to run their own banking business and that they couldn't do it through alliances. And we have seen a lot of that already. So I think this is one thing. The second thing I would say is, with the new technologies, and so this is distributed ledger technology in particular, I think what is open so far is the degree to which DLTs are really going to be broadly adopted by consumers. And in this fintech community, there is this vision that a lot of finance is going to be decentralized, right? So it's not going to be institution-based. It's going to be similar to the internet. It's going to be completely distributed. Contracts are going to be on tokens. And so the role of institutions might change profoundly. I think it's, there's certainly a force like that. And I think Libra used some of that technology, but not to the full extent. But there is a potential in the technology that hasn't really been fully explored yet. And of course, banks are using this technology for payment services, but the fully distributed version of all of that does have a more profound implication. And whether that's going to come into existence or not is ultimately going to be a policy choice. And so I would just point out that thinking through the issues carefully is really important for the future of the trust in the financial system.
Clearly, this trust issue is what everything revolves around, right? Is there more trust in the algorithm? Is there more trust in the institution? Is there more trust in the currency itself? So you have all these different, very grandiose philosophical questions, but that are crystallized in a very practical sense in many of those choices. And I think my running theme here is we still know very little. We have a lot to discover, and we'll discover it not just by smart analysis, but by actual practice and experimenting and testing different propositions and see what sticks and what doesn't. But as to your initial question about banking and commerce, I think it's useful to go back to why the separation of banking and commerce came up in the US. And I think by and large, there were two big issues. One is market power. If you have both industry and finance in the same firm and the firm is big, it becomes enormously powerful. And finance gives it a specific power that it doesn't have with non-financial services or products. And the second one is directed credit, right? If you have a financial conglomerate that has non-financial activities, it will direct preferential financing to its own activities to the detriment of its other customers. So I think both these questions can have a new incarnation in the age of big tech, and the trade-offs here, as we have said time and again, are still largely to be explored. So I was Ugo remembers this. At some point in the preparation of the report, I was really hoping that we would come up with a recommendation for policymakers on your big question: should big tech be allowed into banking? We don't have a recommendation in the report. It's too early. We don't know. But this will be one of the biggest questions in the years to come that policymakers will have to face.
On that note, thank you very much, Nicolas. Thank you all for joining us today for the Washington premiere of Banking Disrupted, the 22nd Geneva Report on the World Economy. I should note that's Banking Disrupted ? In the spirit that Nicolas just said. Special thanks to Tobias Adrian, the Financial Counselor and Director of the Monetary and Capital Markets Department at the IMF, for giving us such a thoughtful discussion. And thank you and congratulations to Nicolas Véron, Senior Fellow at Peterson Institute, and to all your co-authors for an outstanding report. Good day.